Good afternoon, traders. Hope you're having a great weekend so far. It's a nice sunny day here in Edinburgh. Been out most of the morning. Just as an aside, you should always try and get as much daylight as possible in the morning. It's very good for your circadian rhythm, better sleep, and better sleep means better trading. So I had a question from Ron about backtesting while I was out, and I replied that I don't backtest. Now, that's not completely true because I do analyze and journal every trade that I take, go back and make videos about successes and failures, so in that sense I do very short-term backtesting. However, I think in general backtesting historically is not in my wheelhouse, and I just wanted to clear this up and raise some discussion points. So when I was thinking about this, two books came to mind, both highly recommended when you have time. A Random Walk Down Wall Street by Burton G. Malkiel. At the heart of it is an extension of the efficient market hypothesis, which was first described by academics over 100 years ago, but it was Burton Malkiel who first kind of popularized this theory in the 1970s. So it's a hypothesis that states that asset prices reflect all information and that consistent alpha generation is impossible. Now, why is this? In general, all assets are covered by full-time professional analysts, and the fair equilibrium price always exists, because if something was undervalued, then value investors would jump in on it and raise the price to the equilibrium level. This doesn't just apply to stocks, it applies to any asset, including Forex. So you see this dart on the cover, this is based on a famous quote, to paraphrase, a monkey throwing darts at the FT stock page and forming a portfolio has the same chance of outperforming the market as a professional investor. My own opinion, I think if you're investing in large cap equities, then this is kind of true. There's no point picking an active manager because most of the stocks will be fairly priced, so you should just invest in a passive fund and try to capture the beta, like the general trend for stocks to rise due to global economic growth, i.e., companies finding new technologies to be more productive. So another very famous book, The Intelligent Investor, that I used to read cover to cover, describes value investing. So Graham describes in detail a method of investing based on buying underpriced stocks. So these companies typically have low price to book values, high dividend yields, low price to earning ratios. Now, this contradicts the last book because it implies that you can outperform the market by following this method of finding undervalued stocks. Now, if you go and buy a mutual fund, it will tend to fall in one of three camps: value, growth, and core. Now, why am I saying all this? Well, value investing worked great for a while. It tended to outperform the general market, and then that faded over time and began underperforming the broad market. So why? In my opinion, it's because more and more value investors popped up, followed Graham's advice, and over time brought value stocks closer up to their fair value. So value just stopped working. And for a long time, you've been better off buying the opposite of value, which is growth investing, companies with high PE ratios but large growth potential. So I remember not long ago going to interview a value manager in Edinburgh that we had investments in. I won't name it, obviously. They were underperforming, and of course they were saying that value was going to come back into favor and that value was about to have its heyday again. They literally had a spreadsheet that they used applying Graham's teachings and used that to pick stocks and charged huge fees for this. This is a huge problem for mutual fund investing, as the fees, a bit like commissions in trading, eat into your edge. So believe it or not, there's hundreds of such funds that charge huge fees even though they underperform the broad market. Now, how does this apply to FX trading and backtesting? So if I believed the strong version of the efficient market hypothesis was true, I would not be a trader. I wouldn't have dedicated nearly 2.5 years full time analyzing the markets. I can say with 100% conviction that there are inefficiencies in the market that we can exploit. That's nearly 2.5 years of opportunity cost that I could have been doing something else. I'm fairly highly qualified. I could go and work as an investment manager again, but I chose not to. So I want to draw a distinction between two types of trading: mechanical rule-based systems and discretionary systematic systems. At CT, we are the latter. If you are the former, then I think backtesting is useful. If you're looking for some small edge that you can exploit that has been proven with historical data, an example might be, say, the H4 chart shorting when a candle closes below a Bollinger Band and RSI indicates it's oversold. Like, I literally just made this up, so don't trade this. The big problem with this is your returns are going to be low, inconsistent, and the more effective and well-known it becomes, just like value investing, it will eventually stop working. To make this work, you need several systems to cover different market conditions, and it's likely your edge will be very low. You're going to have to spend a lot of time backtesting several different methods, and that's where you're going to find your edge, if you can find one. Now, what I teach is discretionary systematic trading. It took me a while, but I've proven to myself that I can achieve good returns on a consistent basis. Now, am I saying this way of trading is perfect? No, not at all. It has flaws also. I've given you a framework that I've developed over time, tested nearly every single day for years, refined constantly, and it works for me. If you go back to my YouTube video on the 22nd of September, I think it was, I predicted GU would go from 1.1220 to 1.13, 80 pips, and that this was possible with a tiny stop loss, so close to 40R. This was using market profile and dollar index analysis, and I try my best to share my thinking on the group when these trades occur. I've been describing similar trades for a while, so I challenge anyone in the group to say that these trades are a fluke. I would love to debate you. Another very important point is the systematic part of trading methodology that I share. There are 3 clear setups and confirmations, and I preach only to get involved when these occur, and they occur quite often. What I see is a lot of traders in the group who are pure discretionary traders without a systematic approach. They have great analytical skills, but get blown around by their emotions, the neurotransmitters in their brain, like I talk about in the course, and tend to take C and D grade trades out of boredom, etc. This is why I preach to follow a systematic approach combined with discretion, and very importantly, using alerts and not screen watching. So what are the issues with this style of trading? First, I don't think you can backtest with historical data. I've been using logic for each trade, which is fundamentally unbacktestable. Yet I go back and analyze tactical and mental flaws every day and week, but this isn't backtesting in the way most people talk about it. Backtesting also doesn't involve live funds, so it's impossible to test whether you have an edge or not, as emotions are involved when dealing with live funds. Second, it requires brain work, logic, kind of like solving a complex Sudoku puzzle every day. It's not something you can automate and backtest in that regard. And then third, it requires confidence. If you don't have confidence in whatever way you're trading, then you're going to struggle to put, say, 50 lots in the trade and hold it to its logical target. The only way to develop confidence is to practice, for months. My edge is also dependent on my lot size, which I've known for a while, but still tried to push it. I'm comfortable with around, say, 20 lots max for my edge, and I'll just have to accept that gradually I can increase the size and the compounding in a linear fashion, it just won't work for me as a person. I have to go slow. Other people with more experience might be able to go faster, but this is a very individual thing, and it comes down to confidence. And fourth, this is the real kicker, every successful trader has to have an edge and a systematic way of approaching the market. It doesn't matter who you are, Paul Tudor Jones, Ray Dalio, they all have a systematic approach, and it has to suit your personality. I can't hand out a discretionary systematic system and expect every single person to trade exactly as I do, because everyone has different personalities. The successful people in my group will be practicing every single day and picking up methods from various mentors that they encounter on their journey. I see traders in my group who've adopted some of my teachings but also using methods that they've learned elsewhere and have confidence in, and this is great. Like I say, everyone has different personalities and approaches that they have developed confidence in through hard practice. I think a lot of traders struggle to grasp that this is necessary, and they end up system hopping and going nowhere. So, what are the takeaways? 1. Have a codified systematic approach if you're trading with discretion. I've given this in the course, and there are more refinements coming to make it even better, but this will be an ongoing process for life, for every trader, not just me. 2. Backtesting is useless with historical data because we're applying logic and discretion every day, choosing when to get involved and when to stay away from the market. 3. Forward testing is an ongoing process of refinement. Markets are ever changing, and you have to have a strong knowledge of fundamental market dynamics. 4. High returns are possible, but it requires a huge amount of discipline, and you absolutely must be working on your trading psychology actively, just as hard as your entries and exits. If you're not actively working on your trading psych, either using the method I set out or some other method, then you won't succeed. I can help you through this process, but be aware I'm also guiding myself through this process, as I have some flaws that I'm working on too. I'm extremely busy, but after the volume webinar, I'm going to be pushing the trading psych section further once I see more engagement there. Anyway, I'll leave it there. Let me know what you think. I'd love to hear your thoughts, not just in what was said, but what's going to happen in the wheat market. Anyway, have a great weekend. Please let me know your thoughts, and we can have a good discussion on this. Okay, cheers.